Hi, and welcome to What's the Deal, our investment banking series on JP Morgan's Making Sense podcast. I'm Emma Zederfeldt, your host today from the investment grade finance team, and in today's episode, we will take a deep dive into the state of the debt capital markets as we're back from summer. I'll be joined by Todd Rothman, a managing director in our leverage finance capital markets group, to talk about the high yield and leverage loan markets. But before we hear from Todd, I'd like to welcome Bob LoBue, head of Global Fixed Income Syndicate, and John Servidea, global co-head of investment grade finance, to discuss the investment grade bond market. Bob and John, thank you so much for joining me today.
Great to be here.
Thanks for having us.
So John, to kick things off, I think it would be helpful to give our listeners an overall picture of the market. How would you characterize raising capital in the investment grade bond market this year?
Well, Emma, if I had to describe this year in one word, it would be busy. And that's a global comment. So both in Europe and the US, issuance activity is trending well ahead of last year's pace. In the US, we're up about 30% year over year, and in Europe, about 15% year over year. The key driver is really plain refinancing. About 25% of supply year to date is refinancing activity. And the driver of that is that spreads have remained stable despite all of the potential macro headwinds that we've all been talking about. We've seen a supportive backdrop despite the heavy supply, which is great to see. Technicals remain incredibly strong as investors have cash to deploy. And even as we've continued to break some records with some record weeks and some record months, we continue to see investors with appetite to continue to buy. Inflows continue to be strong as well, so we feel really good about the backdrop for our clients.
Thanks, John. Let's maybe shift our focus to today. Bob, what has the environment been like over the past couple of weeks?
Well, as John mentioned, activity has been much larger than we've become accustomed to over the course of the year. And August and the beginning of September have continued that trend. When we look at August, we raised approximately $110 billion over the course of the month. And that's compared to a four-year average of about $85 billion in a usual August. So tremendous supply for the market to digest. In the beginning of September, we did $70 billion in the first week. We'll probably approach about $40 billion going into the Fed. And so once again, we're testing demand for the market. The focus remains on spread premiums and the absolute rate cost for borrowers. And the good news is that despite the heavy calendar, oversubscription rates have remained robust for the supply that we're raising for companies. And new issue concessions were relatively minimal, below 5 basis points. And so from a issuing standpoint, we think it is quite opportunistic for borrowers. On the demand side of things, once again, we continue to like what we are seeing from the investor community. Demand remains robust across the curve, especially in terms of duration, where 10 to 40-year demand is showing the deepest pools of liquidity for borrowers. And when we think about trending into a Fed easing environment over the balance of the year, we anticipate the front-end demand will continue to deepen as investors look to capture that rate reduction in that part of the curve as well.
That is very interesting, Bob. It certainly feels like we have kicked off the post-summer window with a bang. And John, knowing that we have the election looming in early November, how do we think about supply for the rest of the year?
Yeah, so as I mentioned, we expect it to be active, but it is very clear that a lot of our issuer clients have pulled forward transactions just given the strength of the market in the face of these variables around the election, around central banks, et cetera. So we expect it to remain busy, maybe not quite as busy as it has been. But to Bob's point, we feel very good that investor appetite will be there for whatever supply that we do have. Again, that's a global theme. I'd say this year in Europe, we've seen a tremendous strength of the market there relative to the US market. So we'd continue to expect a lot of our US-based clients to look at opportunities borrowing in Europe, where the pricing is highly competitive, if not better than the dollar market. And here in the US, there's a slight uptick, wouldn't call it overwhelming, but a slight uptick in M&A related financing, which is about 15% of the market so far this year.
Shifting our focus from issuers to investors, Bob, you spend a lot of time with chief investment officers and portfolio managers on the buy side. What are you hearing from them, and how are they thinking about spreads and absolute yields?
When we look at the risk asset classes, spreads continue to remain near the tights. And so that is the biggest struggle that investors are focused on is the direction of travel from a spread perspective. Our strategists are forecasting our US dollar spread index to end the year at around 110 basis points. We're currently trading around 113, so modest upside from today's levels. And while we're expecting a widening in Europe of approximately 20 basis points to an index level of about 150 basis points, it leaves us relatively optimistic when we think about the spread environment. Despite that, appetite, as I mentioned earlier, remains strong. Returns have turned positive over the course of the year with the rate rally and spread compression that we have seen. So we continue to see flows coming into the spread asset classes, and that is assisting us in maintaining our levels. Despite the decline in all-in yields, they're quite still attractive. And so when we look at investor demand, we think that they will continue to migrate toward the fixed income and spread asset classes. And especially, once again, mentioning the trend of rates going lower over the course of the balance of 24 and into 25, we think that only exacerbates demand increasing for the fixed income asset classes. We do think that the pace of Fed easing and curve shape as we move forward will likely have the greatest influence on investor relative value opinions. And so that's probably where our biggest focus is in terms of where we think value is and where we believe investors will begin to invest their cash available.
And following up on that, what upcoming events would you say that investors will be focused on?
There's a number of events that investors have on their radar screen that can be quite important over the balance of 24. First and foremost is likely rate volatility. And we think that that is both general market moves that are causing volatility in the market, but also the amount of treasury supply we will get and the receptivity to those auctions. Secondly, the economic data that we'll get over the coming months will be quite informative about the forward trend of the economy and any recession risks. And we think that is one of the big indicators right now for how investors are trying to put money to work. We will get more information out of the central banks. We'll get the Fed minutes on October 9th. That will be quite telling for how they were thinking about the beginning of their easing program. We also have 2 more Fed meetings following the September meeting. So we'll have a meeting in November and in December. And let's not forget, we will get third quarter earnings as we trend into the next couple months that we think will be really important in terms of the forecasting of what companies are seeing on trends around the economy.
And John, turning back over to you, out of these events, which ones do you think are the most important for issuers to look out for?
It's really the Fed, as Bob talked about. It's the trade-off of inflation versus growth. The election, clearly, people love to talk about it and makes a good discussion topic. Historically, though, we found that it has a limited or at least very short-term impact on the investment-grade credit market. So it's really about what is the path of the Fed as we look towards the balance of the year here.
Last question for you, John, before we bring in Todd. Based on your interactions with issuers, what would you say are the most consistent themes that they are focused on?
Yeah, Emma, it's really just an approach of risk management. So a lot of our clients are saying, I don't have the market crystal ball, and neither do we. But as you look at the various issues to navigate out there and the fact that spreads have remained as resilient as they are, and you look ahead to a maturity dollar amount in 2025 that's about 25% higher than this year's, there's a lot of refinancing activity for our clients to do. And so the question becomes, why wait? So it's really, again, a risk management perspective of what are the trade-offs of going now versus waiting, thinking through issuance, hedging, or just sitting tight. And so it's really a very pragmatic approach is how I would describe it.
Bob and John, thank you so much for being here and for sharing your thoughts on the market today. I'm sure this all will be very helpful for our issuing clients as we move throughout the year.
Thanks, Emma.
Thank you.
And now, switching focus from the investment-grade bond market to the leveraged loan and high-yield markets, let's now bring in Todd Rothman, a managing director in our Leveraged Finance Capital Markets Group. Todd, welcome back to the podcast.
Thanks for having me. It's great to be back.
So Todd, as John and Bob just recapped, a lot has happened in the investment-grade bond market so far this year. How would you characterize performance year to date on your side of the market?
So if we start on the leveraged loan market, so far we've had just over $800 billion of supply this year. It's actually higher than the combined 2022 and 2023. And to put that in further context, if you think about the size of the overall US leveraged loan market at roughly $1.5 trillion, that means that we've turned over more than half of the market, and we're only 2/3 of the way through the year, and new supply continues to emerge. Now, as we look at the composition of the money that we've raised in the loan market this year, I'd say 80 to 85% of that has been used towards refinancing. At the same time last year, by comparison, that was only 40%. So we had a lot more M&A and net new money supply coming through the market last year. So borrowers have been able to take advantage of that this year. This technical imbalance where lenders have had a lot of money they want to put to work, but there's been very little in the way of net new supply to put it to work. And that's part of what's allowed companies to come back to market to reprice their loans lower, not even once, but for a number of companies, sometimes twice.
So what's been driving that opportunity set for our clients?
Well, there's two things really happening there. One is what I just mentioned in terms of the lack of net new supply, but the other thing is the CLO market. CLOs make up roughly 2/3 of the buyer base for leveraged loans. And if you look at 2024, we've had roughly $130 billion of issuance so far this year. And our strategists are calling for that number to end the year at roughly $140 to $150 billion. And those are record levels that we haven't seen in quite some time. The final element that's really helped create this dynamic for our borrower clients has been the portion of the market that's trading above par. So typically when we get above 20 or 30% of the loan market trading above par, we've tended to see a repricing opportunity emerge. This summer, we peaked up at actually 65% of the market trading above par. Now, when we had the August volatility, that number dipped down to 13%. But as we've gotten back to school here in September, we've gotten back above 40% again. And so we've seen the beginning of a repricing wave to kick off the autumn period.
And what about the high yield bond market?
So again, very similar to what Bob touched on the IG side, as well as everything I ran through on the loan side, the themes remain really consistent here. Thus far, we've had about $200 billion of issuance year to date. Last year, that was $170 billion. So we're already exceeding last year's pace. If we look at primary volume on the high yield bond side this year, on a gross basis, we're actually running close to 2x the amount that we issued in all of 2023. Yet the amount of net new supply, similar to what I talked about on the loan side, is actually same as last year. So a lot more paper coming through the market, but only the same amount of opportunity for investors to put money to work. The same story holds true there, where roughly 80% of the proceeds thus far have been for refinancing and not for M&A or dividends. One of the results of that trend has been, as investors haven't had an opportunity to put money to work in primary, that's forced investors to look at the secondary market to deploy their cash balances. So if we look back at how the year has played out, this summer we peaked with spreads as tight as around 350 basis points. If you compare that to post-financial crisis period, the all-time tight was 335. So we've been bouncing around the tight levels for the bulk of the year. When you look at the volatility that we saw in August, that actually took us well above 400 basis points. We've since retreated to 374, so still really tight levels, but it's now offering a little bit of spread cushion for investors, which has helped make the market even more attractive for both issuers and for borrowers.
So we've talked about supply, we've talked about spreads. Could you maybe touch on how rates also play into this?
So the loan market being a floating rate asset class, the fact that we've been living with really high rates has been one of the things that's made that market very attractive for the buy side. When we look at things now from the issuer perspective, one of the reasons we haven't seen as much supply in the bond market as the loan market is a bit of a mentality of, why would I issue at a coupon of X today when surely that rate is going to be lower later this year and certainly into 2025 once the Fed starts cutting rates?
With all of that in mind, what is one message you would leave our clients with?
I think one of the things that we need to remind our issuer side clients is back to that spread story. Where do we sit in the world? So today we sit at roughly 375 basis points. If you look back to the COVID period, we were sitting around 440 basis points there. For comparison, I mentioned the tight levels that we've achieved before. We haven't had a recession yet in this economic cycle, but if you look back over the course of the past few decades, high yield spreads have actually averaged around 975 basis points over that period. And so while we're not expecting a recession anytime soon, while we're not expecting spreads to balloon out to those types of levels anytime soon, I think the punchline message that we look to give our issuer clients is that, yeah, the Fed is probably going to start cutting rates soon. We don't know the pace at which that's going to happen. But if we do start to get some economic downturn, some data that makes the market feel a little bit uneasy about growth and future earnings prospects, the direction of travel on all-in coupons could actually go higher as spreads widen out more than the Fed will actually cut rates. So the punchline advice is go grab the money today while it's there at what we think are still relatively attractive rates.
Thank you so much for that overview, Todd. I know that we also recently held our EMEA High Yield and Leverage Finance Conference in London. What was your key takeaway from the conference?
The conference was fantastic. It was one of the largest ones we've had yet. On the bond side, one of the key themes coming out of the conference for sure was that rate cuts are coming. There seems to exist broad consensus that rate cuts from global banks are imminent in the last few months of the year. The pace that that's going to happen and how deep those cuts go into next year is what really remains the moving target. How the market reacts to these rate cuts, I think, is really going to be a function of why are we seeing the cuts happen? Is it more about normalization of policy, or is it more because we're actually seeing a real economic downturn? We're seeing a real shift in employment data and things that are worrying from a growth perspective. In that kind of scenario, we could certainly see spreads widen out a fair bit more. If it's the more benign, pure normalization, we actually could continue to have very attractive conditions for issuers in the year ahead. But again, we encourage people to get out in front of that, not knowing how that's all going to play out over the course of 2025.
And how are things looking from a lender and bond investor perspective?
If we think about things now from the lender and investor side, the fixed income asset class remains a really attractive one to invest in. So despite the expectations for lower rates in the near terms, credit funds continue to attract sustained inflows thanks to the overall appealing yield backdrop and what remains a really benign default rate. So corporate earnings continue to be strong. The high yield issuer base continues to have strong liquidity. And from a credit standpoint, it feels like a safe place to put money to work while still achieving an attractive return. One of the things we also talked about at the conference was what the outlook for supply looks like, because as I mentioned, both on the loan side as well as the high yield bond side, it's been a very refinancing heavy market. And so the natural question we get is what's the outlook for M&A activity as well? The underwritten pipeline for deals is at a 2-year high right now, and that's been supported in what's taken a while to emerge, but a bit more of a convergence in valuation gaps between private equity buyers and sellers, as well on the corporate side. While the numbers are still small by historical comparison, so to give you a sense, coming out of the summer, the underwritten pipeline in the US for M&A, for LBOs, is around $25 to $35 billion. In Europe, it's about half of that. If you put that in context historically, pre-financial crisis between the US and Europe, we had nearly $500 billion of underwritten capital. So it's better than it's been throughout the balance of 2024. It is at a 2-year high, as I mentioned, but there's certainly a lot more room to grow there. We're definitely encouraged by what we're seeing on the investment grade side. We've had some large cap M&A deals emerge, and typically what you see is first you get the large deals get announced on the IG side, and then it trickles its way down into the high yield side. So as we look into 2025, we feel good that we're going to see an uptick in M&A supply versus the past couple of years.
So maybe pivoting to the outlook, Bob and John referenced some key catalysts that may impact risk appetite in the near term. In the context of the high yield and leveraged loan markets, what are you keeping an eye on?
Sure. So on a macro front, what's interesting is we've spent the better part of the last couple of years staring at CPI, PPI, and anything and everything having to do with inflation. We seem to have reached a place in the market where everyone's gotten complacent that the inflation job is done. I think that's a risk. There's certainly a number of inflationary pressures that remain out there, but the market is pricing in right now that that is a non-event, so we'll have to keep an eye on that. Jobs and employment data has really become the new CPI, the new PPI, where everyone's really focused in terms of getting a sense as to what the pace will be of rate cuts to come. Geopolitical risk is still out there. It's been out there, but the reality is that as we've seen a variety of flare-ups around the world, markets have remained incredibly resilient. A lot of that is all down to the strong market technicals that we've had, and by that, I mean the lack of net new supply, the strong cash balances that investors have. Does that dynamic change, in particular, if we get a little bit more M&A supply out there? For international companies, but even for purely U.S. domestic companies, Chinese economic growth is going to be a really important factor. You've already seen a couple of forecasters out there lower their GDP forecasts for this year and questioning whether or not they're going to hit their 5% target. Because of how intertwined the world still is, as China goes, that'll impact corporate earnings a lot. Clearly, in a couple of months, we have a U.S. election as well. We get asked the question all the time, do I need to avoid the markets during October? Does that become a really volatile period? And what's really interesting, we went back and looked at data going as far back as the early 2000s. And when you look at the data, and I'll just use the recent ones as an example, in 2012, 2016, and 2020, respectively, we only saw high-yield spreads rise 1 basis point, fell 14 basis points, and fell 40 basis points, respectively. So actually, you could argue that the election period hasn't been volatile. It's almost been a market catalyst. The other thing that has been interesting is that sort of 1 month leading up to the election. If you look back over the last 3 decades as well, on average, 90 days post-election, high-yield spreads have actually tightened 50 basis points. So you're certainly going to see some election volatility in and around the date. But overall, we don't think who wins is as important as the other factors I've talked about here. I'd also argue in terms of development of more M&A volumes in the market, it's less about who wins the House and Capitol Hill, and it's almost more about what is the new regulatory regime, who's running the various agencies that approve mergers, and does that provide a catalyst or a further hindrance to C-suites and boards feeling more comfortable announcing deals? The final thing I'd mention is just how much markets are pricing in the way of rate cuts for the balance of this year and next year. And I think that's a real wild card in terms of, like I've talked about already, how much actually gets cut, what is the pace of it, and why. And so it's less about what the outcomes are at the meetings and more so, I think, about what the narrative from the various Fed governors is coming out of each of those decisions.
Thank you so much, Todd. A very interesting update, to say the least. To recap, it's been a busy year so far, but the investment-grade bond market is in very good shape. Similarly, high-yield and leveraged loan markets continue to perform strongly and with plenty of capacity for issuers and borrowers looking to tap the market. John, Bob, and Todd, thank you for taking the time to sit with us and give your views on the market today. Also, thank you to our listeners for tuning into another What's the Deal episode. We hope you enjoyed this conversation.
Thanks for listening to What's the Deal? If you've enjoyed this conversation, we hope you'll review, rate, and subscribe to JP Morgan's Making Sense to stay on top of the latest industry news and trends. Available on Apple Podcasts, Spotify, and YouTube. To stay ahead of the curve, sign up for JP Morgan's In Context newsletter, packed full of market views and expert insights delivered straight to you. To subscribe, just visit jpmorgan.com/in-context. This material was prepared by the investment banking group of JP Morgan Securities LLC and not the firm's research department. It is for informational purposes only and is not intended as an offer or solicitation for the purchase, sale, or tender of any financial instrument. Copyright 2024, JP Morgan Chase & Company, all rights reserved.